excited to now kick off our series of presentations. So this year we decided to mix things up a little bit. We typically have lots of speakers and our pitch competition, but we had some workshops at our summit earlier this year that were so popular that we thought it would be really cool if we brought a series of workshops for this morning for you to learn from. So we've lined up a series of experts who are going to be joining. They will be sharing various different topics. So our first one, of course, is going to be raising capital for startups with my good friend Alicia Robb. So we will have several of those take place. We'll have some breaks. And then we, of course, will have the pitch competition later today. As a reminder to everyone, if you're enjoying what you're hearing, please share it out. This is a free event that is meant to show you how you can be a part of building a better future. That's it. Totally free. Anybody can join. It really is our way of giving back to this community so we can build the next generation of women change makers and men. We have lots of men and people of all genders I can see in the audience today, allies as well. We really want more and more people to get this information so they have tools to build the companies that will save the planet. Better for people, better for planet, better for animals. With that being said, Alicia Robb, let's bring you on up to the stage. Let's see where you're joining from. Where are you? Arizona, Colorado. Where are you, Alicia?
No, I actually moved to Kanab, Utah, over by Zion National Park, where Best Friends Animal Sanctuary is located.
Oh my gosh, I have to come out there soon.
Yeah.
It's like a top 3 favorite state for me.
It's magical, as is Best Friends. Yeah, please come on out.
Okay, well,
It's very beautiful.
The Best Friends Animal Sanctuary that Alicia, in addition to being a VC, and honestly, I think Alicia might have been one of the first people I called when I started working on my VC. She was, one of the first early supporters and gave me a lot of great advice and mentorship. And there's nobody I could really think of that would be better to share this advice with other founders. So we're excited to have you. I will pop off stage. We'll bring your deck up and take it away.
Great. Thanks so much. It's good morning. It's great to be here. I'm feeling a bit under the weather, so kind of bear with me as we go through this workshop on raising capital. I'm actually an economist by training. I'm also an author. I have a couple books on this topic, specifically raising capital for women-led businesses. And I've been investing for nearly a decade, first through crowdfunding and angel investing, and then more recently as a fund manager of 2 early stage venture funds, and now as a director on the investment committee of the Kachua Impact Fund. So let's start today. I just want to briefly touch on different paths you can take for funding your startup. There's a lot of different sources out there, and I want to be sure that you understand the costs and the risks of each kind of source. I've taken some slides from Lighter Capital, which is a revenue-based financing company, which we'll talk about as one of the kinds of sources of funding, since I didn't want to reinvent the wheel for new slides, but I just want to give them credit. So let's just start out by, thinking about some questions you should ask yourself when you're creating your funding strategy. First, you have to think about what kind of business you want to build, how big you want it to be, how much capital are you going to need to raise to do that, if you need to take outside capital, how much equity are you willing to give up, if any, what are you going to be willing to risk to fund your business in terms of business and personal assets, how do you want, somebody's saying, is it just slides? Oh, sorry. Okay. How do you want to repay the money? And we'll talk about how you pay your investors or lenders back. Do you want any support or guidance, involvement by others as you grow your business? And then how long is it going to take? Because some of these funding sources do take a while to raise, as Veronica alluded to in the previous session. So how much time do you have to spend raising funds? Because some of these sources are really time intensive. So hopefully you can see this, but it's basically looking at the different kinds of funding options two broad categories are debt and equity. So debt is the shaded line, the striped line, and then equity is the solid. So when you think about who's going to initially start funding you, it's people who believe in you, right? So your friends, your family, sometimes it's called friends, family, fools. How, people who believe in you and believe in your mission. Incubators or accelerators are programs that support you in a startup stage and help you grow. And a lot of times they provide financial capital in addition to human capital, but they do take some equity. So when you're thinking about equity versus debt, this is usually, you're giving up a portion of your company when you do these accelerators. The most common are kind of tech accelerators like Y Combinator and Techstars, but there's also, consumer packaged good accelerators, etc. And these provide mentorship and guidance in addition to capital. Traditional banks are usually not a source for debt financing at the very beginning when you're a startup, but there are financial institutions like CDFIs, community development financial institutions, or credit unions that are mission aligned, and they are more likely to provide debt at the earliest stages. For most like traditional sources of financing, the big banks, you're going to have to provide a lot of assets as collateral for those kinds of loans. And if you're a startup and you don't have any business assets, you're going to have to personally have your personal assets as a collateral. There's equity crowdfunding, and not just equity crowdfunding, but also rewards-based crowdfunding. People sometimes forget that that's a really great source of non-dilutive funding. And you can also build a crowd of consumers that show that you have a market for your product. And so in addition to being non-dilutive, it's also a good way to show product market fit at the very earliest stages of your company. But in terms of equity crowdfunding, WeFunder and Republic, AngelList, those are some of the platforms that allow you to raise money for your startup. And those are equity again. So also equity is angel investors. These are people who invest their own money. It's often geographically based. There's lots of local groups. The Angel Capital Association in the US is one, the membership organization for the US, and so you can search on which angel groups are near you. European Business Angel Group is the similar counterpart in Europe. But if you can network and get to know local angels in your area, before you need money, the best time to build a relationship is before you're asking for funding. There's also groups that are specific to our field, such as Glasswell Syndicate, Vevolution, Vegan Investors, Beyond Animals. So there's lots of groups out there that are actually aggregating investors from this field that have an interest in investing in vegan companies or culture-based companies, cultured meat companies. So, do your research and find, relevant folks that are interested in what you're doing. And again, this is equity, so you're giving up some of your company if you take that kind of funding. Revenue-based financing is relatively new. In the last 5 to 10 years, it's really grown. This is debt, and so instead of a bank loan where you have fixed payments of principal and interest, revenue-based financing is where you pay back a fraction of your sales each month to pay back to a given set of return. So this is helpful in startups if you have choppy revenue. When you have high revenue, you pay more of it back. When you have zero or lower revenue, then your payment goes down. Whereas with a bank loan, you're just paying principal and interest. It's a fixed monthly amount regardless of where your revenues are. So for early stage companies with choppy revenues, this could be a great source of funding. And then once you start getting into the VC or super angels, you've got your first round is called your first round is really called your pre-seed, and then your seed, and those are mainly angels. And then venture capital comes in at Series A, Series B, Series C, all the way up to H or I or J. each time you raise a round of venture financing, you're giving up more and more of your company. So think about that as you are scaling your business, because at some point you're going to get beyond 51% of your company going to investors this route, and then you lose control. So briefly, just as you think about growing, if you're going the VC backed route, you really want to be a company that is looking to be a game changer, that's going to be really large, that has national or international distribution. Venture capital companies are looking for, a 10x return. So you really have to be a large company to offer that kind of return. So if you're just looking to be a large business, even in the millions of dollars of revenues, that might not be enough for going the VC route. So think about options such as using your revenues and reinvesting it back into your company to continue to bootstrap your growth, rather than giving up more and more equity for subsequent rounds of capital. Some people seek a blended path, so you try to bootstrap as long as you can, so that when you are ready to go out for VC funding, you're much larger and you can get a better valuation, and so you have less, you can give up less of your company. So at the idea stage, whichever path you take, it really is about your own money, your family, maybe accelerators or incubators, looking for crowdfunding. As I said, reward-based is a great non-dilutive source of funding. Equity crowdfunding can be an option. Angel investors usually come in at the later idea stage. A lot of angel investors want to see product market fit. So if you're pre-revenue, you haven't shown product market fit, your best bet is really having friends, family, a crowdfunding campaign. You really need to be beyond the idea stage and show that you have some traction, some product market fit, some evidence, and that could be a rewards-based crowdfunding campaign that shows that you have product market fit. So that's kind of the way you get to traction and scale. And then, as I said, you can choose to go the VC route and do subsequent rounds of venture capital, or you can do revenue-based financing, or at this stage, when you have established business and you do have revenues and you do have some assets, whether that be intellectual property or just machinery, etc., that you have collateral, then more traditional banks would be more likely to fund you. But don't forget about these CDFIs and community banks that I mentioned, because they are mission aligned, whether they're regional or topical, and you can perhaps find some earlier stage funding that's non-dilutive by getting loans from those. And we didn't really talk about other sources of non-dilutive funding, but there are grant programs, like the US has the SBIR, STTR. So if your startup uses technology like Veronica's, you can apply for funding from the Small Business Innovation Research and get grants that are quite significant. I mean, the first grants I think are up to $250,000, but that's phase 1, and then phase 2 is up to $1 million. So you can get multiple grants that could be in the millions of dollars, which also helps attract equity investors, because you've taken on all this non-dilutive funding, and so they're not diluted either. So it's a win-win for both the founders and investors if you can get these outside grants, and even like pitch competitions. Some of these have awards. I know companies that have raised hundreds of thousands of dollars just by winning pitch competitions. But at some point, there's the time sink of doing that, and you want to be spending time building your company. So at some point, it's not always going to be a good use of your time, but that's another way to get some non-dilutive funding. How much equity do you want to sacrifice? As I said, bootstrapping friends and family, they can be at times more generous, and so you don't have to give as much equity up for that stage. Banks and revenue based financing, obviously you don't have any equity dilution, but in terms of accelerators, they can often charge 3 to 6. I've seen it as high as 10% or 20% equity that you're giving up to take part in these accelerators. And then equity crowdfunding. There's some sort of equity stake or a convertible note that converts to equity where you're giving up equity there. But it's really the angel investors and venture capital where you're going to be losing 10 to 30%, even more in each round of financing. So just remember, when you get past 51% going to investors, you've lost control. Starting at Series Seed, you're going to be having to build a board, and that board has governance responsibilities. And so you've seen, examples in the news of, founders getting ousted over time. And that is a real risk as you take on additional funding, especially in the later stages in the Series A, B, C. So it's a real risk. And could cost you your company. So in terms of repaying your capital, obviously when investors take equity, the only way they get their money back is when you either sell your company and go public. And very few companies go public. Beyond is one exception, but most companies end up getting money back to their investors by selling to a much larger company. So regardless of who's investing, whether it's accelerators or crowdfunding or angels or VC, they really get paid back when you sell your company to a larger company. That's the downside is you lose your company. You may still be an employee of that company, but you don't own your company anymore. Whereas revenue-based financing and banks offer the ability for you to really scale and grow, but not lose your company through dilution over time to equity investors. So if you're worried about losing control and ownership of your company, then I would definitely suggest, not going the equity route, but think about the revenue-based financing is good for companies that have choppy revenue, because your repayment is a fixed amount of your revenues, whereas for banks you have your fixed payments regardless of where your income is. So even in bad months or bad years, you're still having to make those fixed payments, and that can be really detrimental to companies, and is one reason why some people go out of business, because they run out of cash because they can't pay their loans back. So basically, to summarize, you've got loans from banks, and banks could be traditional banks like the big traditional banks or tech banks, but they can also be community development financial institutions and credit unions that are more mission aligned. For the traditional banks, you really do need to be further along in your company at the startup stage. Unless you pledge your personal assets, they won't normally give you a loan. But you do have some mission-aligned banks that may be willing to do smaller loans, even at the very beginning, which I think a lot of people don't realize. So benefit is no dilution, but there are these fixed payments regardless of your revenue. So it can be risky if you have choppy revenue streams, and if you've pledged your personal assets or your business assets, you could lose your company. Revenue-based financing, again, no dilution. You have to be a little further along and have company assets. They usually want companies that have $1 million in revenues or more, but it comes with the benefit of having, the payments being in relation to what your revenues are. So you do get to full control, and your, repayments are based on your revenues. And then equity, again, as I said, each round of equity financing with angels at the seed stage and through VCs at the BC stage, you're giving up a not insignificant share of your company at each round of financing. So Veronica mentioned, everything takes longer than you think, and everything takes more money than you think. And so it's it's important to really be realistic in the amount of money that you're going to need to scale and spend the time and energy raising that capital, because it's not easy. It never has been, but it's certainly even more difficult right now. There's so many companies out there trying to raise money, and it's not a ghost town, but it's just much harder right now, and investors have more say in the kinds of terms that you're going to get for your financing, and it's not always as entrepreneurial friendly as it has been in previous years. So, all right, so that's kind of a quick summary. We wanted to spend 10 minutes or so on Q&A. Both my email and some websites are here. Kacho Impact Fund, Vegan Investors, Vevolution. They all have great resources for startups and investors on the websites. And my email is there if you have any questions that don't get answered today. Happy to answer those offline if you want. And and we'll go from there. All right, so let's go with the questions. When is it a bad idea to take venture capital? When is it a bad idea? Well, it's a bad idea if the terms aren't good. It is, we are now in a investor-friendly environment. Before, entrepreneurs had much more say when everyone was throwing capital at them, and the terms were much more easily negotiated to benefit the entrepreneurs, and we're seeing the opposite right now. So it's a bad idea to take venture capital if the terms are onerous and you're giving up way too much capital of your company for that capital. It's also a bad idea to take venture capital from just anybody. So you really want to do your research. There's good and bad investors. There's good and bad board members. And you want to do your homework and make sure that you are aligned with the vision of your company, and the investors that you bring on board are aligned in that vision with you. What is the biggest mistake that most founders make? Well, I guess not doing your homework. There's very specific kinds of investors, and so it's good to do homework on who you're pitching, and making sure you're not wasting their time and they're not wasting yours. So I think the biggest mistake is probably not doing your homework and not being prepared. There's certain things that you want to do, and one of the sessions later by one of the folks from Glasswall in a pitch deck, having yourself in a position where you're ready to take funding is really important. And that means having a pitch deck, having a data room with specific things that the people are going to want to see. Investors who are doing their due diligence, they're going to want to see your incorporation documents. They're going to want to see your financials. They're going to want to see projections. They're going to want to see your intellectual property. So I think the biggest thing is making sure that you're ready, that you've done your homework, that you have all of your information ready to present to them, and also to make sure that you're pitching the right investors. I mean, there's some people that invest in consumer packaged goods, and there's some that don't do CPG, and there's some that do cultured, and some that do seed stage or later stage. And so doing research to see what kinds of investments are in the portfolio of those funders if you're going the VC or angel route. So just homework in terms of both researching your potential investors and just being ready for raising capital. So when Veronica said it takes a lot longer, it takes a lot longer, not just in getting people on board, getting that lead investor, and then others will follow. It also takes some time getting everything ready to present to investors. What would be the best, this is a great question, what would be the best funding source for a small CPG, so consumer packaged good company with no plans to sell? For that kind of thing, especially if you have a product already, you could, that would be a rewards-based Kickstarter, Indiegogo campaign. You could do an equity crowdfunding campaign, but if you have, if you have a product and you are small and you don't need a lot of capital, you might want to do the CDFI credit union route and try to get debt financing for scaling. And then as long as you have, revenues and decent margins, you can continually reinvest your revenues back into scaling. If you're a small CPG company and you don't want to sell, you really probably don't want to take on angel financing or venture capital funding, because they're going to want you to sell your company, because that's how they get paid back. What would be the biggest red flag in a VC when looking for an investor? Well, I think it's not so much as a red flag, but if you're looking for, if there's this fine line of folks that invest in your space and folks that have invested in your competitors. So most ethical VCs, if you were a direct competitor, they're probably not going to want to invest in you because they're already invested in a competitor. So I would just be leery of somebody who's already invested in a competitor that's looking to invest in your company. I guess, interviewing, when you're being interviewed by the VCs, but you should be also interviewing them. I know it's a tough environment, and folks are kind of desperate for cash or investment right now, but it really does have very large ramifications for the future of your company. So getting a bad investor is sometimes bad money is not better than no money, and so you might want to just try to do a slower trajectory of growth and take in less outside capital. If you can find angel investors who are investing their own money and they're more aligned, that's probably a better bet than doing VC funding, because VCs are investing other people's money and they have an obligation to their limited partners of a financial return to that investment. Now, angels want return as well. I mean, we're investing our own money and we want our money back with a financial return as well. But I think angels are going to be a more more patient and more aligned and more of a professional relationship. So Jennifer, do you think the industry will ever see as much money as we saw in the last few years? Yeah, I do. I think this is a blip. It's a whole nother issue about, the venture capital model, I think, is pretty broken, which is one of the reasons I got involved with the Kachua Impact Fund. There's really cool funds out there. Mission Driven Finance, Kachua Impact Fund are two of them, where we're kind of not reinventing, but we're thinking of new ways to get funding to companies in ways that are more sustainable and ethical than this like slash and burn VC attitude of, oh, I'm going to have 10 companies in my portfolio and one or two are going to return the whole fund and everyone else is going to die, and that's not a big deal, because it is a big deal to it's a big deal to the founders, it's a big deal to the employees, it's a big deal to the consumers who love those products. If those companies crash and burn and they're no longer available, then that's not good for anybody. But it's certainly not good for the founders or the employees or the communities where these companies are. So I think there's better ways to get funding to sustainable companies, and that's why I think looking at alternatives like revenue-based financing or alternative fund models like Mission Driven Finance and Kachua are I think going to be more proliferating in the future. So.
Well, Alicia, thank you so much for this extremely helpful presentation that I was actually screenshotting. I'm like, damn, this is a really good graphic to explain it. It's so funny because, I get so many pitches, and honestly, 50% of my declines are just saying you shouldn't raise VC. Like 50% at least or more This is not a VC backable company. Don't get VC money, get some grants, get some other type of funding. It's pretty astonishing in my opinion, how much we see kind of confusion over what kind of capital to get.
Yep. VC, I mean, only like 1 or 2% of companies get venture capital. It's not everybody and it's not most, and most companies should not raise venture capital.
Well, that is a good way for a VC to end the statement. To get 30 minutes live Q&A and directly from a VC is really incredible stuff for many of these founders are in the audience. So I just want to say thank you so much. I know you're not feeling so well. Everybody's getting this cold that's going around. I think we have a few speakers today, fortunately, but I hope you have a chance to stay and watch the pitch competition later. And we have a lot more folks that'll be joining soon.
Thanks for having me.